Marcus, and good morning, everybody. Thank you very much for the invitation. I'm very glad and honored to be here. I understand from Marcus' transition that I will be the only one to comment on Werner's presentation, which I don't know is a blessing or a curse. We'll see. I have to say I agree with many of the points made by Hans Werner, not all of them as you can imagine, and I will come back to that in my presentation. But I certainly agree with part of the conclusion, in particular on the fiscal side. I will come back to that. So what I would like to do now is to put this discussion on current counterbalances and on target against a broader perspective. And the way I would like to do it now is to reinterpret the European crisis by speaking about the mechanisms to share risks within the European Union, within the EMU. So this will all be about risk-sharing mechanisms within EMU. First, before the crisis. Second, during the crisis, and this is very much what Hans Werner has described. And also as a conclusion after the crisis. And then I will move to the policy. To some policy considerations on how to make the European system work better. So the first part will be about the risk-sharing mechanisms before the crisis. I'm not going to expand too much on that. As you all know very well, the architects of the euro, those who wrote the dollar report, and then the one market, one money report in the early 90s. And then those who wrote the Maastricht Treaty in 1992, they were all well aware of the theory of optimum currency areas, and they were well aware of the conclusions of the academic thinking at the time, and here I'm speaking of the early 90s. And so they expected firms and households in the euro area to respond much less flexibly to shocks than in the US for many reasons. Financial markets were comparatively less developed in Europe, so there was less risk sharing going on through investments by households. And also labor markets were more rigid, and they are still more rigid. So the mobility of labor across European countries was rather low. And maybe even more importantly, there was no federal system of taxes and transfers, and this is something Werner highlighted at the end of his presentation. So it was a very different environment to set up and run a monetary union. To cope with this situation, European governments have taken a different route. They have kind of accepted the low flexibility of markets and the absence or the underdevelopment of risk-sharing mechanisms through markets, and this has been taken as granted at the beginning of the European Monetary Union. And to address this lack of flexibility, they have bound themselves to foster economic policy cooperation through the Maastricht Treaty. They have committed to foster flexibility within their economies to catch up against the US and to make risk-sharing mechanisms work better. And we'll see how this worked after 1999. And even more importantly, governments have adopted fiscal rules. So they have the big bet they made was to bet on self-insurance through intertemporal risk sharing at a country level with balanced budget rules and stable debt rules through the Stability and Growth Pact. So they believed that most of the risk sharing mechanism could happen at a national level intertemporally. And they gave up to some extent on the possibility to have cross-country risk-sharing mechanisms, either through fiscal institutions at the federal level or at the centralized level through market. So this was the starting point in 1999. So what did we actually see in the first years of EMU before, let's say, between 1999 and 2007 when the financial crisis erupted? Well, we've seen some integration of goods and services markets, but this was probably mainly due to previous commitments to the Single European Act, which was decided in 1987 and implemented in 1992. It may have been to some extent due to the endogenous consequences of monetary union, but as you know, this is very debated. There may have been some more trade in terms of volume, and also the composition of trade within the euro area may have changed, with maybe more trade at the extensive margin, somewhat more trade at the intensive margin, and a lot more trade at the extensive margin. But it's more about the composition than it's about the volumes. And it's very hard to say that the monetary union as such has led to has created a strong drive for further integration of markets for goods and services. When it comes to labor markets, well, here the news are not very good. They've remained very rigid in most countries. Labor has remained immobile across Europe, and you know all this nice empirical research on the reaction of labor markets to shocks as compared in the US and in the euro area, which shows that the contribution of labor mobility to absorbing shocks through the labor markets is much higher in the US than in Europe. Even though it may also have increased somewhat after the introduction of the euro, probably not very much so. And what we've seen in Europe is that most of the reaction to shocks through the labor market has come through changes in participation rates. We've seen that again through the latest crisis, by the way, in countries like Germany or France, where you've seen changes occurring through Kurzarbeit, through work time, to some extent through conversations, but not at all through labor mobility. The mechanisms are very different, and they've not changed a lot since 1990. We haven't seen strong steps towards reforming labor markets, towards introducing more flexibility in the labor markets, except maybe in Germany, in the Schröder government, but in other countries we haven't seen that. We are seeing that now, but this will be later in the story. We're seeing that, as you know, needed. I can address later. So again, this was very much adjustment at the country level through mechanisms within countries, and not a lot of risk sharing across countries. Then, when it comes to the fiscal performance, well, it's very well known that many countries had entered the EMU with a high level of debt, and they've done little or nothing to address that. They've done little or nothing to reduce debt after entering the euro. The debt to GDP ratio in France was 57% of GDP in 2000. It was 64% of GDP in 2006, just before the crisis. Same in Germany, 60% in 2000 and 68% in 2006. Same in Italy, Greece, etc. There was no substantial efforts to reduce the level of debt, to make room, to create room, to adapt to recreate fiscal space after the So of course, the device which was meant to implement this kind of fiscal discipline was the Stability and Growth Pact, which was created in 1998, and it hasn't really worked. It will work in the future, but it doesn't work very well between 1999 and 2006. So now the last point, which may be the most surprising one, is that something still has happened, and this is the development of integration of financial markets. So the point I would like to make here is that we haven't seen much integration in the markets for goods and services. We haven't seen much integration and much flexibility in the labor market. We haven't seen much efforts to put fiscal positions on a more sustainable footing. But we've seen a lot of integration going on through financial markets. This may have been the biggest surprise as compared to what was initially envisaged. So we have at the ECB a set of indicators for financial market integration in Europe. We have this report on financial integration in Europe, and the latest one has been released a couple of weeks ago on the ECB website. There is a lot of cross-country and cross-markets information on convergence, both before the crisis and after the crisis. Well, and after the crisis, I'll come back to that a little bit later, because this has not been convergence, but divergence. I'll come back to that. But let me just sum up and say that before the crisis, we've seen a lot of convergence in money markets. We've seen a convergence in bond markets. This has been highlighted in the previous presentation. We've seen some convergence also in some integration in equity markets, even though they remain more fragmented than either money markets or bond markets, through a series of regulatory initiatives. This is the Financial Services Action Plan, the non-fiduciary report, etc. We've seen a substantial political drive to accelerate the integration of financial markets. Just to give you an example, the share of equity issued by euro area residents and held by residents of other euro area countries, so cross-country equity holding, this share has doubled between 1997 and 2006, from 15% in 1997 to 30% in 2006. So we've seen a lot of evidence of accelerated integration of financial markets. And maybe the most striking sign of financial market integration and therefore of risk sharing through financial markets in the first years of EMU were the current account deficit and surpluses, which Werner has described, and I agree very much with the description. We've seen large current account deficits being piled up, being financed internally within the euro area mostly, not so much through international capital markets, but a lot within the euro area. Just to give you a few figures, Greece saw its current account deficit rise from 7% of GDP to 15% of GDP before the crisis. Spain from 3% to 12%, Ireland from 0 to 7%, and this was very much the figures that were shown. Portugal from 3% to 5%. So these deficits were financed by European markets and largely by investors from a single country, which was Germany. This is very much the story.
Via France, typically.
And
we lend it to your banks and you send the money to the fund.
Yeah, or via Ireland also in some cases. I come back to investors' behavior in Germany. I'll come back to that later. We've seen in the first years of EMU, we've seen the Feldstein-Oreoka puzzle disappearing, so to speak, and this was nicely highlighted very early on by Olivier Blanchard and Francesco Terratti, among others. So at the face of it, there was a simple theoretical explanation, which was just a convergence, productivity catch-up, and the need for less wealthy countries to activate it. And this was good. I mean, if this was that story, then it was perfectly okay that capital would flow to Portugal, Spain, and Greece to help build up capital and catch up productivity levels. The problem is that we really could see two phases. So this convergence or catch-up story was probably the case in the early years of EMU, but then at some point there was some overshooting, and so it was not as much about investing in productive capacities in these countries, and there are increasing signs that high GDP growth rates in these countries were not accompanied by comparable developments in productivity. It was probably the case in the early years of EMU, but beginning from the mid-2000s, I would say, increasingly capital inflows were not accompanied by comparable development in productivity. And even more worryingly, current account deficits were amplified, were exacerbated by expectations of future revenues in these countries, which were not reasonable. And this may have been encouraged by a globally benign economic environment. So it's not only a European story. This was a time where the whole economic environment was very supportive. It was a great moderation, and capital was flowing everywhere. But still, you have this particular European dimension of current account opening up, widening because of unsustainable expectations of revenues in some Europe. And as this boom continued and expanded, we've seen also a gap in relative prices. So I'm not going to go into the details. This was nicely shown by Werner. We've seen the divergence of unique labor costs between Greece, Ireland, Portugal, Spain on the one hand, and core European countries, and in particular Germany on the other. And so with the benefit of insight, of course, is the magnitude of the current account deficits and surpluses, and also the magnitude of the gap in relative prices should have been interpreted as should have been a warning, but So the conclusion here is that we've maybe the only well-functioning risk-sharing mechanism that we've seen in the early years of EMU was integration through financial markets. Why did it turn badly? Well, there was an outside shock in 2007, of course, but probably the fact that we had so much investment in countries which was not accompanied by high productivity growth was also the reflection of bad risk management of these investments. So I would say that there is a shared responsibility between the borrowers and the lenders. You have to be in the tango. And so there was also responsibility of those investors, and including French investors, German investors, investors from more wealthy countries at the time, which invested without adequate risk management and also most likely a lack of regulatory oversight of understanding that this resulted in hidden liabilities developing throughout the system. Hidden liabilities were developing in countries which were piling up debt, and it was not very well understood, it was not properly understood that these liabilities, even though they had originated in the private sector, because these were private investments, would eventually migrate to the balance sheets of governments when they would assume systemic importance. This was not very well understood. So the impact on government balance sheets and the ultimate impact on debts and deficits was not understood at the time. It was very much felt as a private sector issue. This is very much the situation that we had before the crisis, and of course there was a major fragility, which was this dependence on financial markets to achieve risk sharing, which made the whole system very vulnerable when financial markets stopped functioning in 2007. This was a major fragility. And probably insufficient attention was paid to the possibilities that markets could at any time become segmented along national borders. So the fault lines, in fact, were very apparent because the fault lines were just national borders, and which we should have been there. So what happened during the crisis? We've seen a collapse in all segments of financial markets in Europe, and you remember the story. I'm not going to go through it again. We've seen the interbank market freezing, in particular the unsecured interbank market froze in 2007. And when it came back, it did came back in 2008, 2009, but when it came back in a fragmented way, and very much fragmented along national borders. And we also could see a deterioration in the secured interbank market, for instance in the repo market, which we can still see even though there have been some recovery and even though the repo spreads have come back towards normality, to some extent, the volumes in the repo market are not at all the same as the permanent impact also on the secure interbank market. We've seen divergence in yields on money markets. We've seen divergence in yields on government bond markets, of course. We've seen cross-border holdings of bonds by European banks being partially unwound, contrary to what happened before the crisis. And increasingly, we are seeing pan-European banking groups tempted to keep liquidity within countries, to segregate liquidity within countries, to manage national pools of liquidity, contrary to the period before the crisis, where they had single pool of liquidity. So these are all evidences of fragmentation and segmentation. In equity markets, the impact of the financial crisis seems to have to be more limited, as we don't see a major impact of the financial crisis on cross-border integration of equity markets. But overall, when you look at the global picture, much of the pre-crisis progress in terms of European financial integration has been destroyed. So, of course, since this was the only properly functioning risk-sharing mechanism after 2007, and even more so after 2010, when the sovereign crisis hit, the euro area was left without risk-sharing around. This is when the public institutions of the euro area stepped in, and here I'm getting closer to Hans Werner's presentation. We've seen assistance packages by governments and by European governments and by the IMF. So the EFSF and the IMF have provided financing to Greece, Ireland, and Portugal. So you could call that ex-post risk sharing in a sense. This was not prepared ex ante, but ex-post. Governments and the IMF had to step in. There were also policy actions which were not directly related to funding, but which have been taken to restore confidence in the soundness of countries and in the soundness of banks. Just to give you an example, we had the stress tests and the capital exercise of the European Banking Authority last year, the EBA, with this target for a 9% core tier 1 ratio in July 2012. This is not about financing, but this is an initiative aiming at restoring the ability of banks to finance European economy. When it comes to the ECB and to the euro system, we've taken measures to ensure the transmission of monetary policy across European economies and to ensure a smooth functioning of the payment system in Europe. And this has in effect resulted in the ECB to some extent or to a large extent substituting for the euro area interbank market, which is the story that Hans-Werner put forward. But the reasons here are really about monetary policy. This is about ensuring the uniform transmission of monetary policy everywhere in the euro area. So it was not acceptable from the point of view of the ECB, which is a central bank of the euro area, and which is running a single monetary policy in the euro area. It would not have been acceptable to see monetary policy signals being transmitted in some countries and not in some others. And with the crisis, with the impairment of financial markets in Europe, there was a whole part of the euro area where monetary policy signals were not being transmitted anymore, because money markets were not working and bond markets were not working either. So we've taken a series of measures. We've cut the policy interest rate to a very low level. We've provided reserves to bank at a fixed rate and with a full allotment, meaning that we've chosen to match fully the increase in the bank's demand for reserves. This has been matched fully by the ECB. This is the fixed rate full allotment policy. As you know, we've lengthened the maturity at which we provide reserves to bank by launching 2 or 3 year refinancing operations, the LTROs. So the reason for that is first, as I mentioned already, to ensure the uniform or more uniform at least transmission of monetary policy by matching the demand for reserves originating in countries where the interbank market was not functioning anymore. And these are the peripheral countries. This was a way also to prevent deflationary pressures. The basic reason why we decided on the LTRO in November of 2011 is that market-based funding was becoming very scarce for European banks, and there was a very substantial risk of European banks being cut off from international markets and having to deleverage in a disorderly way, which would have resulted in a significant increase in bank lending to the economy, and this would have caused risk for price stability. So there is a price stability argument, which is that the situation in the autumn of 2011 was a situation of a near credit crunch in a large part of the euro area economy, and without action from the ECB, the credit crunch would have materialized and would have severely impacted the economy and also on prices. And also at times we have undertaken direct interventions in selected financial markets. We have set up a program to buy covered bonds, but in limited amounts. And as you know, we have set up a program to intervene on some government bond markets where the increase in yields was considered an obstacle to the transmission of monetary policy. And this is the securities market program, the S&P. Well, of course, the effect of this policy was very different across European countries. Typically, the banks that were experiencing the most severe funding strains were operating in countries which were the same countries which ran large current account deficits, and you've seen the figure. So you had a conjunction of current account deficits and capital deficits, and the purpose of the intervention of the ECB was to ensure that each bank in the euro area, irrespective of its location, irrespective of its country, would have sufficient reserves to deal with the possibility that creditors may refuse to roll over loans. So it was really a way to address the situation of each individual bank in the euro area, irrespective of the this has resulted in the target 2 imbalances, which Hans Werner has very precisely described. Target 2 is the clearing and settlement system operated by the ECB for large value flows in Europe. So national central banks in the euro area can build up claims vis-à-vis target 2 over time, but target 2 is only the mirror of the underlying economic and financial imbalances. Target 2 is a mirror of current account deficits and capital deficits. If the interbank market was functioning properly, no claim would appear in target 2, and it was very much the situation until 2007, when the financial crisis erupted. So we would see nothing in target 2, and the underlying economic issues would be exactly the same. We would have the same current account issues, we would have the same capital account issues, but this could not be seen in target 2. So this is for me the evidence that trying to address the European crisis through by acting on target 2, by constraining the flow of funds through target 2, this would be addressing the symptoms of the crisis without addressing the causes. And we should really focus on current account imbalances and on capital account imbalances, meaning the functioning of capital. If we constrain the functioning of target 2, we will hamper the freedom of capital movements in Europe, which is a freedom in the European treaties. And we would hamper the smooth operation of payment systems, which is one of the core tasks of the ECB. So the role of the ECB here is not to finance current account deficits or to finance capital account deficits. This is the outcome in the aggregate. But the role of the ECB is to make sure that each bank in the euro area has enough liquidity to do its job, meaning to finance the economy. And to smoothly functioning payment system. So the role of the ECB is really a microeconomic job. We don't have a macroeconomic job in this The ECB only talks with and let me also, just as a reaction to the earlier presentation, let me mention that there is no money creation in any single euro area country. Money is being created by the ECB. It is being distributed by national central banks and then lent to individual banking institutions. But there is no money being created in Athens or in Lisbon, or and no money being destroyed in Frankfurt. It's a unified system.
But it is shown in the balance sheet. So what is money creation if it appears on the right-hand side of the balance sheet of the national central bank?
Because the national central banks are the agents of the euro system. It's a decentralized system, so they are the operators which implement the distribution of liquidity to national banks. But it's a unified system. So if in 1999 the founding fathers of Europe had chosen to have an integrated system, as it is the case in any country, then if São Paulo Intesa would borrow directly from the ECB in Frankfurt instead from borrowing from the Bank of Italy in Rome, then the outcome in terms of monetary policy and in terms of liquidity distribution would be exactly the same. We wouldn't have target 2 at all. This would be a purely internal device. You wouldn't see anything in the balance sheet of LCBs because we wouldn't have LCBs anymore, and the system would be functioning exactly the same. Exactly the same.
Rather those who the ECB system. That's the
So you have two totally different set of issues. You have the organization, the institutional organization of monetary policy in Europe, which is decentralized. And so we have this system which is unique, but this is due to the euro area is unique generally, with a centralized decision-making by the governing council of the ECB, and then decentralized implementation by the national central banks. And then you have a completely different question, which is the functioning of interbank markets and the fact that interbank markets are not functioning. And this is completely unrelated. So let me come to the future, because it's more important to discuss the future than to discuss the past. Here I would like to make a strong to express a strong opinion that the system we're living in currently should not last too long. We've seen public institutions in Europe, governments on the one hand and the ECB on the other hand, with different considerations and different mandates, substituting for the functioning of private decentralized markets. This should not be the long-term, the steady-state situation in Europe. Financial integration should remain a prime objective of all European authorities. Financial integration remains key to the efficiency and to the competitiveness of the European economy. It has delivered a lot of benefits between 1999 and 2007. So it would be totally absurd from our side to ignore the benefits of financial integration and to accept as a steady-state device a system where the financing of European countries would be performed by public institutions. This is not the right way to go. The EU is a market-based economy. And decentralized markets should play the primary role in allocating the economic resources across the EMU countries. Because we need price signals, and this point was made by Hans-Werner, and I very much agree with him, that we need price signals at a decentralized level. And we need the monitoring of risks associated to the financing of government deficits and surpluses. Well, you could argue that before 2007, we had a decentralized system which didn't deliver the appropriate monitoring of risks. So certainly also there are things to be changed in terms of supervision and maybe in terms of the organization of the financial sector in the private economy. But still, without coming back to this decentralized allocation of resources, we won't have the right price signals and we won't have the right monitoring, in particular in Southern Europe. So let me outline some of the priorities that I would see to revert to an economically sensible steady-state situation. And let me break the discussion into 4 areas. First, we need adjustment in current account deficit countries. And we need to continue to support the adjustment in these countries. So there will be a continuation in particular of IMF and European financing, now through the ESM, which is a long-term mechanism, which makes it possible to support the adjustment in peripheral. So it's adjustment and financing. This is the usual story. We had a lot of financing, now we need a lot of adjustment. Looking forward, it will be very difficult. It will be very challenging, but again, the example of Ireland shows that it's possible. We have the example of Latvia, this was discussed yesterday, which shows that it is possible. So it will be different depending on countries, but there is no other way out than to have this price level adjustment in And also we have new institutional mechanisms to enforce that. We have a new excessive imbalance procedure, which will be managed by the European Commission, where the Commission will identify imbalances early on and will propose solutions, and ultimately we could have sanctions on countries if they don't accept the solutions proposed by the European Commission and the other European. So we have stronger institutional mechanisms to monitor and to correct current account imbalances in Europe. This is the first avenue. The second avenue is on the fiscal side, and here it's pretty much, again, along the line of what Hans-Werner has said. We have a new treaty of stability, coordination, and governance in Europe, which is what is commonly known as the fiscal compact. It include in particular balanced budget rules at a constitutional level or a quasi-constitutional level in all individual countries. And this should be now ratified promptly and applied consistently. And again, this gives a great role to the European Commission, because the European Commission will be in the driving seat to identify fiscal imbalances and to let me just note here that the rules of the fiscal compact, they concern the structural budget deficit. They don't concern the cyclical component of the budget. And so it should make it possible to restore some kind of intertemporal risk sharing through the budgets when budget deficits are back to structural balance, because then the structural balance will be enshrined into national constitution. So it will be a much safer mechanism, because the implementation will be at a national level through the constitutional mechanisms of each country, rather than in Brussels through an ECOFIN and a discussion with the European Commission. So it will be legally and politically so this is an absolute priority for European countries to go back to fiscal balance and so that they can recreate fiscal space to adapt to shocks. This was the second priority. The third priority, which is maybe the most important in my view, is to recreate financial markets in Europe. And this is a long-term project. There are many dimensions. Certainly the ECB is not alone in that project. The ECB may have a role to play, but in coordination with the European Commission, which is in charge of enforcing and protecting the single market for capitals, and also with European supervisory authorities, such as the European Banking Authority. It is absolutely indispensable that we can recreate a single market for capital in Europe. Well, if you remember well, and for those of you who read the Delors report early on, or the Cecchini report also in the 90s, in fact, the EMU, the single currency, was introduced as a complement to the single market. It's very much a byproduct of the single market for goods and services, and the single market for capital movements as created by the Single Act of 1992. And so it is really ironic that the outcome of this crisis is the EMU without capital mobility, because EMU was created in a way to protect capital mobility in the European Union. I mean, this is the Mundell impossible trilemma in a sense. Another way to look at the story. We've chosen this route of free capital mobility within Europe, and we needed a single currency. Now we have a single currency, but we don't have a capital mobility anymore. Of course, we will not return to the kind of financial integration that we had in the pre-crisis era, because this financial integration we had before the crisis, this is the kind of financial integration which led to the crisis. So we should certainly return to it. We should try other way to recreate European capital markets. So there should be, let's call that a financial compact, which would complement the fiscal compact. We need these financial compacts with initiatives to recreate capital markets. One important component, of course, and maybe the short-term priority, is to restore the capital adequacy of banks, because we need confidence, we need trust in European banks. This is the priority, and the capital exercise of the European Banking Authority goes a long way towards that direction. It may not be enough, we'll see, but we need to restore trust in European banks. A second component would be to reflect on the other regulatory initiatives, so as to make sure that they don't create obstacles to the restarting of the internal market. And here I'm thinking in particular of the liquidity ratio as foreseen in the Basel III agreement. The liquidity ratio should be implemented in a way that is not an obstacle to the recreation or to the restarting of the internal market, in particular in its cross-national dimension. So it should not be an impediment for German banks to lend to Italian banks or for Dutch banks to lend to. And very much on the way this liquidity ratio will be implemented also at a national level by national supervisors. And also, I would like to add that one of the priorities is to break the link between the credit worthiness of banks and the credit worthiness of sovereigns. This is, of course, one of the lessons of the current crisis. There are many dimensions here, but one important progress would be to have an harmonized regime for bank resolution in Europe, and maybe later on to have a single European agency for deposit insurance and for winding down payments. Without this single authority for banking resolution, we won't disconnect the credit of banks from the credit of sovereigns. It's not easy. There is not a lot of appetite on the side of governments to do that, but we should begin working. And finally, the fourth aspect is about non-financial markets. It's about, in particular, the labor market. It has been forgotten in this crisis that part of the reasons why the euro area was why the functioning of the euro area could be improved is that labor markets were not flexible enough, and that labor mobility was not enough across euro area countries. So we are hearing now of governments wanting to put forward growth initiatives, wanting to put growth back on the European agenda. From the standpoint of the ECB, growth initiatives are welcome, provided that it's about potential growth. So it's provided that it's about supply side reforms and not about additional public spending, which is an important caveat. And this will be an interesting discussion with those governments. And also provided that the promoters of these growth initiatives take the perspective of the single market, as opposed to the perspective of national governments. It's really our role as a European institution to you may have noticed that my 4 points make little mention of the ECB as a solution to the crisis. This is because, in our view, the single monetary policy can at best support the required reforms. Our best contribution can be to continue providing liquidity to banks, provided that they are sound, and provided that they have high quality collateral. Otherwise, we should not provide liquidity to them. And also to ensure the smooth functioning of the payment system, and maybe above all to continue to deliver price stability. And this will be our contribution. So let me conclude. I would like, just as a way of conclusion, to quote the last lines of James Ingram's paper on European monetary integration, which was published in this university 39 years ago. And these are the last lines of Ingram's paper. It's obvious that the necessity for perfect confidence in the permanent fixity of exchange rates in a monetary integration ultimately confronts the reality of national sovereignty, which implies the right and power of a nation to change its mind. Europe has so far resolved the potential conflict between sovereignty and federalism through negotiation and through compromise. Such resolution may become increasingly difficult as integration becomes closer. Without some signs of political unification, it may be particularly difficult to convince capital markets that exchange rates are irrevocably fixed. This is the conclusion of Ingram's paper in 1973. So negotiation and compromise indeed have become more difficult as integration has become closer. But the EU is a union of democracies, and European governments should be more trustful of the power of democracy to produce the solutions that will address the deep causes of the crisis. Signs of political unification, as referred to in Ingram's paper, are needed. They are needed because we need to combat the fragmentation of Europe. We need to combat the fragmentation of European markets, and we need also to fight the temptation to raise national barriers and to take actions losing sight of the necessity to protect the single market. And all of these are political issues, and this is why James Ingram's conclusion was very visionary.